right, so we are seeing a bit of a mixed start to the session today, and some investors were asking the question, have we run too far, too fast? Remember the malaise that we saw in August, September, October, and then a big rebound so far in November. Let's bring in Michael Rourke. He's Chief Market Strategist at JonesTrading. Mike, I know that you've had a very cautious view on the broader equity landscape and a lot of those technology stocks that have been flying higher this year. So maybe a bit of a pullback is not a surprise to you. How would you describe, in your opinion, the state of the markets right now?
Well, I think what we have is, it's been the same theme all year. Money has flowed into the Magnificent Seven names, the seven largest stocks in the S&P 500. We've seen the rest of the other 493 names trade flat. And that's where money's hiding for the time being, as the market awaits to see how, the higher interest rate environment affects business, affects the economy. We're starting to see that slowdown emerge here in Q4, but there was a really strong Q3. So I think investors are just at this crossroads that if you're not in those Magnificent Seven names, it's really hard to decide what to do at this point. And I think you're seeing a lot of people just stay on the sidelines.
And it's kind of interesting because you had a lot of strategists who were cautious coming into 2023, some that held that cautious view through the run-up that we did see in 2023. And I know it's a bit skewed because it's more tech than anything else. But in recent days, I've noticed a number of Wall Street strategy firms that are predicting big things for 2024. What are your own expectations on what kind of equity performance we could see in the new year?
I think we're going to see, I don't want to say more of what we've had this year, but I think you're going to see things level out. I think the attraction of those Magnificent Seven names will diminish as next year plays out. And that's just going to keep a market going sideways to lower. We're still grappling with what will be a high interest rate environment from an economic perspective. And while the market is betting on significant rate cuts next year, that there's no real justification for that with 4% inflation, and the Fed hasn't really done anything to signal that that's the path they want to take. So I think we'll just have to let the environment play out. What has happened in 2023 is the economy's been much stronger than anticipated, and that's probably because monetary policy wasn't tight enough, and now we're probably at the point where it's going to start to be felt in the economy.
Well, we had a conversation earlier in the program with Ed Devlin and David Rosenberg, both who are very concerned about where the Canadian economy is headed. They feel very strongly we're going to see a notable reversal in interest rate strategy for the Bank of Canada. As it pertains to the markets, though, one thing that David argued was against the idea that corporate earnings can remain somewhat robust, which some of the strategists are talking about a reasonable earnings picture for 2024. I guess the sort of the disconnect with someone like Rosenberg is, well, if the economy is cooling down, how can corporate earnings be growing? What's your view on the profit picture next year?
Well, I agree with David there. When you think about the earnings season that just ended, basically prior to, a couple of weeks ago, no one would sit there and say it was a robust earnings season or there was anything great that came out of it. As far as even those Magnificent Seven names, Microsoft was the only one that whose report the market really liked, and that even still wasn't all that impressive considering the stock's added $1 trillion of market cap this year. So I think there's a lot of excitement and hope in this market, but it has been backed up by the numbers. And as you go into next year, we'll have a full, we'll be going into that environment with high interest rates and with higher borrowing costs. I think it's just going to be more of a challenge to grow on top of that.
Okay, so we're just looking at a little scorecard for our television audience of some of the areas that you're watching within the market. You think generally the U.S. market is expensive. That tech and communication and consumer discretionary have not priced in the risks of an economic slowdown. Are there any parts of the market that you do like? I feel like for the last several years I've been talking with you about bank stocks. We've got banks in Canada reporting their quarterly results this week. But is there any pocket of the market that you do like on the equity side?
Well, now that we know the interest rate hiking cycle is almost, it's almost certainly over, I would say. It'd be a surprise to see any more hikes here in the United States. I think the groups like the banks, like the utilities, like the REITs, who've had, faced the headwinds of a higher interest rate environment or a tightening cycle, I think that headwind is now behind them, and that gives them a clear field going forward. So I think those are the groups I would look at. I mean, personally, I think that 2-year Treasury note's really attractive at a just sub 5% yield. And again, if we have an economic slowdown in the United States, you want to be in the bond market because we're seeing the best yield levels we've seen in 15, 16 years, and they'll rally if the economy slows.